ETF, or Exchange Traded Fund, is a security that tracks an index or asset. These funds can be inexpensive and easy options for diverse investing, but you should never invest in something you don't understand. Before diving into ETFs, it's important to learn the ropes. First, how does an ETF work? Let's explain it simply. One easy way to understand ETFs is to think about them like a burrito. Inside a burrito, you have ingredients like avocado, salsa, rice, and beans. When you take a bite, you get a little bit of everything. ETFs are the same. They're a collection of stocks and bonds that may be purchased for one price. When you buy a share, you get a little bit of everything. People like ETFs because they diversify your risk by investing in many different assets at once versus putting your money in just one stock. Now, how is this different from mutual funds or stocks? Let's look together. Unlike mutual funds, ETFs may be bought and sold during the entire trading day, just like stocks on an exchange. You could say that the ETF is a relative of the mutual fund, which is another way to purchase many stocks at one time. But there are a few major differences between ETFs and mutual funds. For one, mutual funds tend to have human mutual fund managers who actively trade stocks in and out of the fund based on which ones they predict will go up or down. However, the vast majority of ETFs are not managed by humans. Instead, many ETFs are programmed with an algorithm that simply tracks an entire economic sector or index, like the S&P 500 or the US bond market. For this reason, mutual funds are generally referred to as being actively managed and ETFs as passively managed. Now, to wrap things up, let's quickly sum up the positive and negative aspects of ETFs. On the positive side, ETFs are well known for their benefits to investors. First off, they are much cheaper to purchase than purchasing shares in many different companies individually. Second, they offer risk management through diversification practices. Third, they let investors target specific industries or markets easily. Now, there are also some negatives. First, actively managed ETFs may have higher fees associated with them. Additionally, ETFs may have some lag and inefficiency in tracking the indexes they're supposed to. And last but not least, ETFs can be over-concentrated in a sector or industry. This exposes you to risk if there's a downturn. Watch our other videos to learn more about specific types of ETFs.